Ladies and gentlemen, Assalamu alaikum and good evening. I would really appreciate if you could all please take your seats so we can begin with the proceedings. Thank you. I'm Sakhi Babar, and on behalf of State Bank of Pakistan, let me extend a very warm welcome to the Honorable Speaker, Governors of SAARC Central Banks, executives of national and international financial institutions, esteemed diplomats, respected members of academia, government officials, media representatives, and all my colleagues from the State Bank of Pakistan to this 24th Zahid Husain Memorial Lecture. Ladies and gentlemen, I would really appreciate if you could all please turn your mobile phones to silent mode, so in order to avoid any disturbance during the event. Thank you. Let me first give you a brief overview of today's program. We shall start the program with the recitation from the Holy Quran. After the recitation, I will invite the Honorable Governor State Bank, Mr. Jameel Ahmed, for the opening remarks and to introduce our esteemed speaker for today's session, Dr. Asim Ijaz Khawaja. The introductory remarks by the Governor shall be followed by the lecture, which shall last for about 40 minutes. Lastly, we shall have a moderated question and answer session for about 20 minutes before concluding the program. Without further ado, let's begin the proceedings for today with the name of Almighty.
Bismillahirrahmanirrahim. Qul huwa Allahu ahad, Allahus samad, lam yalid wa lam yulad, wa lam yakul lahu kufuwan ahad.
Jazakallah. State Bank of Pakistan has been arranging the Zahid Husain Memorial Lecture Series since 1975. This flagship event of the Central Bank is organized for two main reasons. First, to recognize the pivotal role played by our first governor, Mr. Zahid Husain, in the establishment of the country's central bank, as well as his numerous other services for Pakistan. Second, in order to provide an accessible platform for interaction between world-renowned academics and policymakers to discuss the pertinent issues of ever-changing global economic and social landscape. State Bank of Pakistan has always held this tradition in esteem and has invited world-renowned economists, financial market practitioners, and development specialists for sharing of ideas under this forum of Zahid Husain Memorial Lecture. In today's lecture, Dr. Khawaja shall be reflecting on democratizing lending, the challenges and opportunities for financial inclusion in emerging economies. Ladies and gentlemen, let me now request the Honorable Governor State Bank, Mr. Jameel Ahmed, for his welcome remarks. Ladies and gentlemen, Mr. Jameel Ahmed.
Bismillahirrahmanirrahim. Honorable SAARC Finance delegations, learned speakers, Speaker Dr. Asim Ijaz Khawaja, distinguished guests, ladies and gentlemen, Assalamu alaikum and a very good evening. Thank you all for joining us in the 24th Zahid Husain Memorial Lecture, one of the flagship events of the State Bank of Pakistan. We organize these lectures to pay tribute to Zahid Husain, the first governor of the State Bank of Pakistan. These memorial lectures offer the opportunity to discuss some of the most important and pressing economic issues of our times. Zahid Husain Lecture Series started in 1975 at this occasion of the silver jubilee of the State Bank of Pakistan. Following the spirit associated with this tradition, we are pleased to have this evening a renowned economist, Dr. Asim Ijaz Khawaja, to share his views with us. Before Dr. Asim starts his discussion, I would like to briefly touch upon Zahid Husain's contribution for this nation. As we all aware, this country faced incredible challenges immediately after independence. During such testing times, Zahid Hussain stood amongst the dedicated lieutenants of the Quaid-e-Azam Muhammad Ali Jinnah. He was a legendary personality of a very high caliber and served the country at the highest levels. He started his career with teaching at Aligarh University. Then he passed the competitive examination for civil services and joined finance department of the government of undivided India. After partition, he was posted as the first High Commissioner of Pakistan to India. He also served as the chairman of Taxation Inquiry Committee and first chairman of the Planning Board, thereby authoring the 5-year development plan of the country. He spearheaded the Central Bank of Pakistan through its infancy, which was not an easy task by any means. On the one hand, he had to deal with the challenge of establishing a safe and sound financial system for the country. And on the other hand, he was to cope with the daunting task meeting the huge financial requirements of the economy that was already in the midst of passing through precarious conditions after independence. However, the commendable talent, unwavering determination, and the relentless efforts of Zahid Hussain made it possible to achieve this uphill task. We at the State Bank of Pakistan feel honored to have him as our first governor and hope that we can carry his legacy forward with same ideals that he embodied. Ladies and gentlemen, I now take the honor to introduce the speaker of today's Zahid Hussain Memorial Lecture. Professor Dr. Asim Hussain Khawaja is a well-known economist. He is Director, Center for International Development at Harvard, Professor of International Finance and Development, Harvard Kennedy School of Government, MBA class of 1953, visiting Professor of Business Administration, Harvard Business School, and co-founder, Center for Economic Research in Pakistan. His areas of interest include economic development, financial inclusion, education, political economy, institutions, contract theory, and mechanism design. His research combines extensive fieldwork, rigorous empirical analysis, and microeconomic theory to answer questions that are motivated by policy. His articles have been published in the leading economics journals, such as the American Economic Review and the Quarterly Journal of Economics, and have received coverage in numerous media outlets such as the Economist, New York Times, Washington Post, International Herald Tribune, Al Jazeera, BBC, and CNN. His research work ranges from understanding market failures in emerging financial markets to examining the private education market in low-income countries. He was selected as a Carnegie Scholar in 2009 to pursue research on how religious institutions impact individual beliefs. Dr. Khawaja received BS degree in economics and in mathematics with computer science from MIT and a PhD in economics from Harvard. He was born in UK and lived in Kanu, Nigeria, and Lahore, Pakistan, before moving to Cambridge, Massachusetts. Dr. Khawaja also serves as the faculty co-chair of an education program, Rethinking Financial Inclusion, Smart Design for Policy and Practice, aimed primarily at professionals involved in the design and regulation of financial products and services for low-income populations. His today's talk will be on democratizing lending, the challenges and opportunities for financial inclusion in emerging economies. With this brief introduction, I invite Professor Dr. Asim Ijaz Khawaja to share his thoughts with us on the topic. Over to Mr. Khawaja.
Great. Hello and assalamu alaikum to everyone. It's a pleasure to be here. Before I begin my talk, just wanted to say a few words of thanks to Governor Jamil for a very kind introduction, to the other governors and experts in the audience. Thank you for spending time together today. Governor Jamil mentioned sort of our first governor, Zahid Husain Saab, and kind of his contributions. In many ways, Pakistan finds itself in similarly trying circumstances today as well. And it's not just Pakistan. There are several countries which are finding themselves in equally trying situations in the region. Sri Lanka went through a really tough time and is hopefully recovering from that. And so I think just to keep the perspective in mind, and it's not just emerging economies, you can see what's happening in the US closer to home for me with bank collapses and the like. And I think it's a good opportunity for us to think a bit about how we should rethink financial institutions in general, but also in the case that I'm talking about today, how we should think about changing different instruments, financial instruments. I'm going to focus on lending today because I think when you think of a lot of the macroeconomic challenges our countries face, at the end, the underlying factors are actually not macroeconomic. The underlying factors tend to be microeconomic. It's not an issue if a country or individual borrows. The issue is whether they can be productive with the money that they actually have borrowed, right? And so it's not that Pakistan is an outlier in terms of debt to GDP ratios. I think countries which are struggling with debt are mostly struggling not because they have borrowed more or less, it's because they haven't made productive use of the money that they borrowed, and therefore they may be unable to repay it. And so I really want to focus on why is it that we struggle with that question, and how do we improve lending behavior in a way that can lead to more productive returns to lending and therefore eventually a better and healthier economy overall. So I'll go through a bunch of slides, but I would like to keep time for questions at the end. There are many familiar people in the audience. I'd love to hear from them, but also there are others who I don't know, and I'd love to hear from them as well. So let me jump straight in into my slides. I should say some of the work I'll show, I will acknowledge the State Bank. I'm very fond of the State Bank of Pakistan because it's personally been very instrumental in my research career. Another collaborator of mine is Atif Mia, who's a professor at Princeton, and his research career. And we actually started our research careers in 2001. In fact, with a conference where the then governor of the State Bank, Ishrat Hasan, was there. And so some of the work I'll show you today is actually harkens back to that collaboration. Ishrat Saab at that time and the central bank, the State Bank of Pakistan, was very open to research collaborations. And they shared a lot of data, which we subsequently used in a lot of different research projects. And the one thing I'd love to say to the various governors and dignitaries today is, the more you can open up your resources, your support, your data to outside researchers, the more we can start improving financial products and instrumentation. Obviously, one has to protect privacy and the like, but I would encourage you to really, I don't know if Ishrat Saab is in the audience today, but I would encourage you to think about those models of research collaboration between researchers and regulators, researchers and financial institutions. I do think it can have a lot of promise. So with that, let me sort of jump straight in to the point I want to make today. And so, we all know this. I'm going to use some data from the global Findex data that the World Bank regularly publishes. It's a very nice resource. I'm sure you're all familiar with it. But I just want to make this point that, we still in the world kind of are challenged with financial access. Now, this is a statistic we often give. It's not necessarily the best statistic, but it's still a useful statistic, which is, just account ownership. Do you have access to formal accounts, formal banking accounts? And you can see there's still, over 1.5 billion people still don't have access to a formal account. Now, again, this isn't the solution. Just making a bank account doesn't solve the problem. But at least it's one indication of the nature of the problem we may be facing. I think a better statistic is the one which is also in this report, which I'm showing now, which is just the share of adults who have borrowed at all in the past year. And you might think that 50% is actually not a bad number for borrowing, but this is actually a very liberal definition of borrowing. This includes money from a financial institution, or even just using a credit card or just mobile money. And so when you think about it that way, it's actually not a very high number. And so this is a good use of saying, are people using financial support of some kind to actually further their own objectives? And you can imagine this includes consumption purposes, investment purposes, dealing with shocks and the like. And so we would hope this number would be larger. And you can see in sort of the richer parts of the world, this number is definitely a fair bit higher than, say, emerging economies. If you want, you can look at the SAARC countries as well, and you can see, the rates are pretty low actually in kind of our part of the world. Similar holds for Africa. Latin America does somewhat better in terms of emerging economies, but still there's a ways to go. So the problem isn't just a problem of Pakistan or a problem of South Asia. It is a broader problem. And even in countries which have large or improved financial access, like the United States, that doesn't mean that it's healthy financial access. We've had enough financial crisis in the US. Hopefully the one we're currently experiencing won't become a financial crisis. But there's enough financial challenges even in richer countries that suggest that we haven't quite figured out how to do financial intermediation as well as we could. So, one question is, why is, and I said meaningful financial access, because like I said, simply opening a bank account doesn't give you financial access. Meaningful financial access to me would be you get the right products for the right need that you have, and those products are well designed in a way that they're both commercially viable and profitable for the financial institution, but they also add value to the person accessing finance. And that's what a financially meaningful product would be. So why are we lagging? Now, there are different theories you can put up. I'm only going to examine two types of classes of theories. The first one isn't really a class, but I mention it because we often in the emerging world worry about this a lot. For countries which are trying to renegotiate deals with the IMF, this is akin to what you're worrying about, which is the problem really liquidity? I think of finance typically as plumbing, and no offense to my financial colleagues. What finance inherently does is it tries to redirect money to individuals who need to access money. And so you can think of money being water in a reservoir. This is the amount of deposits an economy might have. And you could think of individuals who are accessing that money for consumption purposes, for insurance purposes, for investment purposes, and the like. And one view of this system is that really we're suffering from a water shortage. We're suffering from a shortage of funds, right? And you might say, well, is that really a problem? Well, I would argue most countries obsess over this problem. When we talk about attracting foreign funds through remittances or FDI or lending through multilaterals, we're really presenting ourselves as the problem being lack of money. And the premise over here is that if you could just fill this reservoir up, you can generate currency. I put dollars because I was partly being tongue-in-cheek, since it seems the way the Pakistani currency is these days, perhaps that's a more stable metric to be using. But this problem of lack of funds is a very powerful way of thinking about development. And to me, as an empiricist, my work is very data-driven. And so for me as an empiricist, I'm fine with having interesting ideas, but ultimately those ideas should be tested using data. And so are there real proofs of this concept to say, really, the problem of financial access is lack of funds? As long as we can have an economy flush with money, then the people who need the money will eventually get it. So let me give you two pieces of evidence which suggest that this is actually unlikely. And the important thing, the message from this, if this is unlikely, is that the obsession that many of us have, many of you may have in the room, many of your institutions may have, which is trying to attract funds, perhaps is not as important as you might think it is. Okay? So let's see if there's any evidence for this seems unlikely comment that I'm making. The first example is two colleagues of mine, Carmen Reinhardt and Ken Rogoff. Carmen just recently stepped down as the chief economist of the World Bank. Before that, she was a colleague of mine, and she's now back to being a colleague of mine at the Kennedy School. And Ken, who is in the economics department, both are colleagues of mine at Harvard. And Ken and Carmen have this paper, this book. Many of you are probably familiar with this, but I'm just replicating a graph from their work. And the graph basically tries to check whether having more money is generally a good thing. And so what it does is it traces over 200 years of our history, and it basically tries to see how much liquidity there was. And so how much kind of capital mobility there is. This is the red line in the world at any given time. So like 1914 had a lot of liquidity. There was a lot of capital mobility. Money was moving around at that time, as it was in the kind of early 2000s as well. And then it correlates this. It plots a second series, which is a fraction of countries in the world which are in a financial crisis. Okay. And what you find is interesting. What you find, contrary to what you may expect if you thought money is, the lack of money is the problem, is when you put more money into the system, you actually seem to be getting more financial crisis, not less. Now, this isn't a causal relationship, so I should be very careful over here. This is just a correlation. We don't know what's causing what, right? But nevertheless, if your view of the world was that my main problem in my economy is trying to just raise more money from internal or external sources, this figure should give you some pause that maybe that view is not quite as strong as you thought it was. So this is kind of from an across-country, long span of history view. I'm going to give you a second example, which actually comes from Pakistan and is based on research that Atif and I did a few years back. And this research was actually enabled simply because the State Bank of Pakistan, and I mentioned this earlier, was willing to share data with us. And so we had access to really rich data to be able to answer an interesting question, which is what happens to an economy when you pour lots of money in it. 9/11 in the case of Pakistan, and actually very much in a lot of parts of the world, especially Muslim countries, was a huge credit inflow into the country, right? And you know the reasons for this. What I'm showing you is a few graphs, time series. The graphs themselves are different ways of thinking about liquidity in an economy. The red line is 9/11. And I go from 1999 to about 2003. And what you say is, if you look at the top left panel, remittances massively increase. What you see is foreign exchange reserves massively increase. This is the bottom left panel. And not surprisingly, when you have this much liquidity coming into the country, what you'd expect to see is the law of supply and demand is if there's a big supply shifter, price should fall. In other words, domestic interest rates should drop. And you see that happening in the top right panel. Okay. So this is I can imagine not to put the governor on the spot, but I imagine if I showed you these figures and the red line was January of 2024, you would be a very happy person, right? Because, you know, currently we're struggling with reserves and remittances and the cost of capital. So this seems like a great thing for an economy in terms of liquidity access. Okay. By the way, you may worry that, you know, 9/11 is also the time when there is a war going next door. A few months after 9/11, Afghanistan gets bombed, and there's a lot of insecurity. And so one question could be, sure, you have more money, but remember supply and demand. The supply of money may have increased, but perhaps the demand for money may have gone down because there's insecurity. Now, again, if you know anything about economics and wars, you know that wars typically, when they're not happening in your country, are actually good for your country. They actually create an economic stimulus. I'm not advocating for a war, but I'm just saying from a simple statistical sense. And unsurprisingly, when you look at Pakistan, the bottom right-hand graph is showing you the demand side. So I showed you the supply side on the earlier graphs, and the demand side is pre and post 9/11, what is happening to demand, if you will, in the Pakistani context. And what you can see is actually you have demand going up. There is greater investment, there's greater exports. In fact, default rates are going down. And it's not surprising because what happens, for those of you who are familiar with this case, what happens is because there is a war in Afghanistan, there actually is a construction need soon after the war. And, you know, you can't fly cement over from the West. Cement and bricks and construction and the like comes from neighbors. And so that's what's happening. That's beginning to happen. The point I'm making is, if you did a very simple, for those of you who remember basic macro from ages ago, aggregate demand and aggregate supply, you have a situation where there's both an aggregate supply shifter to the right, so there's more liquidity, and if anything, there is more demand. So in a world like this, what you should expect to see is significant amount of lending to various entities, particularly to the most productive entities in your economy, which would be firms. And so what we find, and so now I'm going to switch and say, okay, this is what the macroeconomic situation is showing. It looks like good news in the macroeconomic situation. Let's turn to the microeconomic situation, to the lending behavior, and tell you what's happening. And on the lending behavior, what you see is very different. What you see, the top two graphs are showing you lending to firms in the economy. And I'm showing you lending to small firms and lending to large firms. And the first graph on the left shows you lending to firms which are already borrowing. So these were firms which are already borrowing from the financial system. And the question we asked is, given money is so much cheaper now, and given, if anything, you have an investment boom going on, you would expect these firms to borrow more. And instead you see nothing. There's no change. So if you remember the graphs I showed you, to the right of the red line, everything was moving up. Right now, I'm showing you this, everything to the right of the line is just as flat as everything to the left of the line. This, and you might say, well, maybe you didn't want to lend to existing firms because they were already borrowing as much as they wanted, even though that doesn't make sense, since if the cost of capital goes down, it's cheaper to borrow. You actually should borrow more. So what I do instead on the right-hand side, what Atif and I do in this paper is we look at lending to new firms, not newly born firms, but firms which are not borrowing before, which may now do an NPV calculation and say, well, the cost of capital has gone down. Projects which had probably not positive NPV maybe have positive NPV now, so maybe I should borrow. But you see there's no change there, again, for small or for large firms. So this is a pretty strong indictment of a financial system saying, look, at a time when money was cheap and there was business opportunities to be had, you should have grown, you should have borrowed. And by the way, again, if you're worried about the current situation a country like Pakistan is in, if you have a system like this, which is even in good times, you can't leverage the advantage, then, you know, even if you renegotiate a loan from someone, from some multilateral, this says that you're not going to do much with the money, and which worries you when you start thinking about paying back that loan, right? And so this raises a deeper question to say, what is happening in this economy? Why is it the case that they're not able to facilitate lending to potentially higher return opportunities? What is interesting, by the way, and I'll show you the bottom graph, during the same time period, you actually do see something which is going up a lot. There is a line to the right of 9/11, which is going up, and that's, as one indicator, the Karachi Stock Exchange index. And so the question becomes, if there's money flowing in and banks are not lending more money to firms, where is the money going? And again, if you were there at that time period, you would know this from your own personal experience. The money went into various things, like the stock market. And by the way, this is a time when Pakistan was very proudly declaring that its stock market is growing rapidly. Now, another word of caution, we did some papers on the stock market as well. Again, we had a chairman of the SEC at that time who was very data friendly and shared data with us. Simply because market cap or market valuation goes up doesn't necessarily mean good news. Good news is if you have more money being actually raised and new IPOs and new listing happening. This period didn't see a lot of new listings happening. It was just stocks were just rising in price. And so what was happening was money was pouring in because money was cheap and more speculation was happening. We don't have a good data, at least not that I have access to, on land prices in Pakistan. But my guess is if you had looked at the same index of real estate prices, that would have also gone up. In fact, many banks were actually lending to people who were actually buying land. I know in Pakistan, land is considered a great investment. Atif has talked about this, and I agree with him, and I've kind of emphasized this point as well. Simply buying and selling land is not a productive activity. It's a speculative activity, just like buying and selling stocks may not necessarily be a productive activity. And so what was happening was this money that was coming in was moving not into real investments, but actually fueling consumption booms and fueling speculative booms. Okay? So the question becomes, why is this going on, right? And in the little cartoon picture I showed you before, it seems this idea of putting more money in the reservoir leading to good things only works if the plumbing isn't leaky. But if the plumbing is leaky, what an imperfect financial system is leaky plumbing. If the plumbing is leaky, and I'm being very simplistic in what I'm saying, but sometimes finance is much simpler than we make it out to be. It actually is pretty straightforward in some ways. Now, if your financial system has weakness in it, when you put more pressure in it, when you ask it to funnel more money through the financial system, it can create distortions. Some of those distortions could be straight out rent-seeking behavior. Some of it could just be inefficient lending. If you can't handle the money to firms, you just give it to people who will use it for whatever other things they can do. Now, again, I'm not against consumption lending. It's a very important thing to do. I'm against lending which is typically unproductive. Okay? And that's what puts us in the trouble that currently Pakistan is in. It puts us in trouble that Sri Lanka was in a little while ago, and perhaps many other countries in the world are currently finding themselves in. So my conjecture is the problem is that the financial system, the plumbing, has lots of bad pipes, has lots of leaky pipes, right? It's not as good as we think it is. So let's start thinking about how do we make a better financial system? And I'm going to again focus on lending and ask myself and ask ourselves, how do we get lending to work better? So let's think about what is the challenge in lending, right? The challenge in lending is quite simple, actually. You have people with money and you have people with ideas. And what you're trying to do is simply match the two, right? And you might say there's a distribution of people with money in your economy. That's the yellow circle over here. It's a Venn diagram for those of you who remember math from those early days. And maybe there's a distribution of people with ideas, which perhaps is even more people have ideas, which is actually, I think, an accurate restriction. In a country of Pakistan with 200 million people, the people with money are probably less than 1 million. And the people with ideas, I'm hopeful, are probably more than 50 million, right? So typically there's a much skewed ratio over here. Now, the intersection of the Venn diagram, again, remember, if you remember Venn diagrams, are people who have money and ideas. In a poorly functioning financial system, the only ideas that you see happening in the country are ideas that are at the intersection of the Venn diagram. There's people who have money, can fund their own ideas. You walk up to your uncle or your father or your aunt, and you simply borrow money for them because they're in your family. Okay. In a system which has good financial intermediation, you should see the ideas that are outside of the intersection also being created. Okay. And that's what we mean by missing GDP. In a poorly functioning system, only a very small fraction of the ideas that should exist in the economy exist. That's what bad financial systems, that's the GDP cost of bad financial systems or poorly functioning financial systems. By the way, if you want to know whether your economy is in this situation, you might say, well, I don't know what ideas exist that should be there and aren't there. That's a counterfactual, that's hard to assess. But there are warning signs in your economy that you may be in a situation where you're not doing a good job. And what are the warning signs? Let me give you a couple of warning signs. And my guess is most of your economies have these warning signs. If you have the dominance of family-controlled firms, I won't mention any people in the today in Pakistan, some of them may actually be in the audience. It'll be very awkward for us. But if your country has lots of firms which are owned by large family businesses, if you have ethnic groups, which are considered to be more business-oriented ethnic groups, if you have lots of foreign-owned firms, these are all signs that you may have a problem of financial intermediation, because there is no reason to suspect that ideas only come from rich people. There's no reason to suspect that ideas only come from one caste or one ethnic group versus another ethnic group, right? Ideas are distributed, we would expect, randomly in the population. If anything, you might think that poorer people have more ideas because they are more desperate, they are more driven. And again, if you've hired people in Pakistan, you can tell the difference between someone who is hungry, who wants to do stuff, and typically they come from more modest means because that's what they're trying to change about themselves. You will also see unproductive firms. You will see firms which are not doing very well, but somehow still surviving. And again, you can put this lens on firms in your economy and say, one way to test if a firm is unproductive, for instance, is it able to compete in the outside world without subsidies? That's a good measure. A colleague of mine, Ricardo Hausman, uses this measure a lot to say, are you exporting? Are you creating goods which are export-worthy goods, and you are able to export or not? You may see idle capital as well. Okay? So these are signs that you may have not well-functioning financial systems. Okay. But why is it so hard? And I don't want to be unfair over here. This is a hard problem. But let me first, agree with all of us, what is the problem you're trying to solve when you're lending? And the problem you're trying to solve is actually just two problems. Conceptually, they're very straightforward to describe. The first problem is a selection problem, right? You're trying to select good people, right? Good entrepreneurs, good borrowers, right? You want to select people who, when you give them, say, 100,000 rupees, they're able to use that money and convert it into a multiple of 100,000, maybe 300,000, maybe 500,000, but at least more than 100,000. Okay? So that's the first thing. You want to select the right kind of people with the right kind of ideas. And the second is you're not guaranteed when you pay, and as a banker, you all know this, even if someone takes a loan and productively invests in and makes money, they may not want to necessarily repay it back to you. So you want to ideally select borrowers who are trustworthy, who are honest, who don't mind paying back if they're able to pay back. So that's the selection problem. There's a second problem, which is called a monitoring problem. which is a sister to the selection problem, right? Which is, even if you select the right entrepreneur, you want to make sure they're doing the right thing with your money. They're investing it appropriately. So you may want to monitor the investment. And this is why, for instance, say a venture capitalist often seeds management of a company that they invest in. They add their own management team to a company that they invest in. And they also want to monitor good behavior. When you take collateral, that's a way of ensuring good behavior so that repayment behavior ex post is also good. So these are the two problems you're trying to solve. Our conjecture, and we did some research, we estimated, and this was a few years back, so these numbers are probably even larger now. We estimated that because of this matching problem, you may be missing about $4 trillion of GDP, millions of jobs, in countries, because you are not creating ideas which could exist. And when we talk about finance being important for growth, the essence of that argument is exactly this. Finance is important for growth if it's able to fund ideas which couldn't have otherwise existed. So what do we do, right? And you can ask yourself, and I'm going to speed up a bit because I want to leave time for questions. You can ask yourself, how do financial institutions in my ecosystem solve these selection and monitoring problems? Banks, microfinance organizations, or venture capital industry. These are primary lenders in most economies. And I would argue, while they have good intentions in trying to solve these two problems, they also create further problems sometimes in solving them. So let me just give you a few examples for each of these institutions. So for banks, what do banks do? We ask collateral. We ask for collateral because collateral may be a signal of quality. People who can offer collateral must be good to begin with. It also helps repayment because if I have collateral, you're less likely to default. But fundamentally, what collateral does, it means you're lending money against money. So if you don't have money, but you have an idea, well, good luck. And you can try this in any bank in the world, including your banks from the parts of the world you're from. If you simply lack collateral, it's very difficult to get a loan from a bank. There are some banks which give uncollateralized lending, but it's much trickier and much harder to get. The other thing is you require credit ratings. Again, this is a chicken and egg problem. How do you build a credit rating? Well, you build a credit rating by borrowing. Well, if you can't borrow without a credit score, well, how do you build the rating in itself? So it becomes like this weird catch-22. Okay? So that's banks. And again, they're great things as well. I'm just highlighting a few challenges. Venture capitalists, what do? So venture capitalists screen ideas, but it's a very costly process. You spend a lot of time trying to figure out whether this person has the right idea. And in fact, there are lots of biases in that. Minorities, women typically have a harder time getting money, even in developed countries like the US, because a lot of venture capitalists tend to be from one group and they don't quite understand or care about perhaps screening other groups. Venture capitalists also want really rapid exits. They want to make money in a few years. They don't want lifestyle businesses. They don't want long return businesses. They want rapid return businesses. And that means a certain amount of challenge or certain type of business which works and others which may not work. You might say, well, the solution is microfinance. Of course, we've had amazing innovations. I don't know if we have colleagues from Bangladesh, but Grameen and what Muhammad Yunus initiated sounded like a great innovation. But even there, it's challenging. We use social capital or joint liability to try and get money back. But the focus in this industry and more recent research in this industry has shown that the financial returns are actually problematic. You can get the money back, but not because the business did well, is because you put pressure on the poor person to return the loan. So you have notorious financial crises like what happened in Andhra Pradesh, where suicides happen with farmers. And so there's a dark side to this industry as well, because it's focusing on repayment and not returns. And also the loan terms may not quite be conducive to investment behavior. Remember, if you're investing in something, you may have delayed returns. So if you have to make monthly payments, the only thing you could probably borrow for is working capital needs, but investment needs requires a different kind of financial product, which typically the MFI industry has a harder time offering. Although, again, there's innovations here as well. So what do we do? And so I'm just going to end with two examples, and I'd just love to open up for broader discussion. So I think what we can do is, first of all, we can go back to the basics. And I encourage a lot of bankers. I've worked over the last 2 decades with lots of bankers, I find, and other financial institutions. I find some of them are very innovative, but I find a lot of them are not. And so I'm pushing you to be innovative in your context as well. So we need to come up with better ways to solve these screening and monitoring problems. And the trick is, use the fact that the world has changed around you. It's not just that ChatGPT is being used right now, but basically we have lots of data and processing power and information. And so I'll give you 2 examples, and I'll end just to prove, as I said, I'm an empiricist. I don't like saying things theoretically without showing proof of concept. So I'll give you 2 examples where utilization of alternative data has worked. One example is something I did research on. I have a paper on. You're welcome to look at it. I'll cite it here. The other is actually a company, a startup that I created, because sometimes you joke with academics and say, you guys write papers, but you don't do things which are practical. I would disagree, actually. A lot of us do practical things, and there's nothing more practical than creating a company which is successful. And so I've done that as well, and I'll show you examples from both. And there's also a technology revolution, which I think is behind some of these interesting ideas. So the first example is just utilizing the fact that this is a hint, people have access to the internet. More people have access to the internet than they're borrowing. And so that tells you something interesting as well. And this is also from the Findex data from the World Bank. So how can we improve financial intermediation? And I'll give you 2 examples, like I said. One is peer-to-peer lending. And peer-to-peer lending is a market which took off a few decades ago and is continuing to grow, where you have people lend to people. You don't go to banks, you don't go to financial experts, you don't use credit scores necessarily. You just have individuals helping other individuals, but in this case, in a financial transaction where they expect a financial return. We have a paper in Management Science published in 2016, which actually looks at one of these markets called Prosper. And it shows that this market does a better job. And this is a technical way of looking at how a screening instrument works. There's something called area under the receiver operator curve. I don't have time to give technical, but for those of you who understand credit building models, you know what this statistic means. And AUC, area under receiver curve, more than 0.5 means that you're doing better than random. And what this paper shows is that when we use credit score, which is a standard way we do, we get an AUC of about 0.6, which is decent. But what is really interesting is when you use individuals who are non-experts and have them decide on a lending decision, as long as there are many of them, the trick is crowdsourcing, you can get an AUC of 0.73, which is actually really good. In particular, non-expert lenders do a 45% better job than the financial credit score does, at least in this environment. And so that's intriguing. What are they doing that the financial expert is missing out on? I'm not saying we should give up on financial screening. I'm simply saying there's a lot more information we are not utilizing. My guess is most banks in Pakistan, most banks in your parts of the world are actually using much less information and building credit scoring models than they could be using, and they should be using. By the way, this is pretty easy to do. The only thing blocking it, and I've been working with banks in Pakistan, is bank bureaucracy and bad data systems, and just a honestly old-fashioned thinking. Technically, it's pretty easy to do these things. The second example is a company that I created. I was a co-founder of this company, and this company was basically using personality to lend. And so we were saying, look, why don't we directly measure ability and honesty and these kind of skills through surveys, right? And this is the idea behind a company called EFL, which since then merged with another company and is now doing its own thing. And what this company did, what this idea was, is that we would measure people's ability and their willingness, right? Through an online questionnaire. And by doing this, we would then literally, you could walk in without any credit history, without any collateral, and we would simply give you a 20-minute test, and we would lend in an hour against that test, right? So you could just, in fact, eventually we could do it in minutes. You would just take the test, and a few minutes later, you would have a response. You might say, well, this is silly, you will lose money. Turns out we didn't. By the time I had sort of exited from the company, we had dispersed about $1.5 billion in 27 countries. We'd processed about 1 million applications. And just to show you how the credit model worked, I'm showing you in South Asia, Southeast Asia, Africa, Sub-Saharan Africa, Latin America, the performance of the model, which is the way to think of this model is the vertical axis is default rate. The horizontal axis is how well you scored in our screening test. The first is the best scorers. And what you want to see is this graph should slope down, which means people you think are good, that you predicted to be good, are actually low defaults. And that's exactly what the model did. So this meant that this lending was commercially viable and profitable for banks. But importantly, it massively improved financial access, because the kind of people we were lending to were people who had no collateral to offer, no financial history, no rich family member who could vouch for them, right? And that's the whole point about financial access, which is when we create these credit or collateral requirements, we create massive barriers to financial access. This has moved on. There's now a lot of interest in using psychometrics, which is what we did, using mobile data, which is what a lot of people are beginning to do, use online social data. I'll end with a last graph, which is based on our own internal calculations, which is how valuable these different data sources are. And the way to think of this graph is the vertical axis tells you how readily available the data is. So the higher you are, the easier it is to get that data. It's available in principle. And the right axis tells you how good the data is so far that we've seen. Again, this is internal calculations we've done. This graph will change as we get more and more data, but how predictive that data is. So when you look at credit bureau data, which is the bottom right, the size of the circle, by the way, tells you how difficult it is to implement this. Bigger bubbles means lower cost of implementation, easier to do is a bigger bubble. When you look at credit data, you see it's quite predictive, but unfortunately, it's less available. A lot of people in the world don't have credit scores, and so it's less available. When you look at something like psychometric data, which is what we used, everyone has a personality, right? So as long as you can answer 20 questions or 20 minutes worth of questions, we can get that data from you. It's decently predictive. Mobile data is somewhere in between. Online data is getting to be, it's still not as available, but that's increasing rapidly over time, and its predictive power may change over time. So I'll end now. The bottom line of what I've said is basically, look, we need to solve these two problems. Design really matters. And what we're looking for is innovation. And I understand a lot of you are central bankers, but I'm hoping they're bankers and innovators in the audience as well. My request to central bankers is create an ecosystem where innovation can happen. Innovation does not mean risky behavior. You can have prudential innovation. You can have innovation which changes the entire ecosystem, which fixes those leaky pipes. Ultimately, that's a much better way for a regulator to proceed than to constantly be worried about problems. So I would, some of the most innovative regulators I've met are regulators who actually promote innovation in their ecosystem in a sensible way. So I'll stop now and I'll stop sharing my slides, and I'm happy to take questions and go to the moderated session.
Thank you, Professor Asim, for such a wonderful lecture and for sharing with us the insights on one of the most important aspects of our regional economies today, that is financial inclusion. After listening to the lecture, I'm sure all of us have a lot to think about, and many of us are curious to know more as well. So without further ado, let me just open the floor for questions and answers. In the interest of time, I would request you all to please keep your questions short and precise. And if you've already asked a question, please allow others to avail this opportunity and ask questions as well. The people who are here with us can ask questions by raising their hands, and we'll pass the mic on to you. And for those who have joined us virtually, can also ask questions by using the hand raise option And we'll take your questions on your turns. Thank you.
And may I suggest we take like 3 in a row? I think that's typically more efficient. And so I'm happy to I'm just taking notes or questions, and I'm happy to answer them in bunches of 3 or something.
Sure, thank you. Let's head to the first question, please. Siddham, could you pass on the mic to the third row?
Thank you, Saki. Thank you, Dr. Asim. Almost half a decade back, I took your course of in financial inclusion, rethinking financial inclusion. The question, I am from the Central Bank of Pakistan, Samar. The question is that you see in a scenario where the biggest, you see, customer of the banks are the government treasuries themselves, where they can earn a very good return. How could you see the central bank push the banks to do whatever you have mentioned, you see, sort of going into all of those innovations and things like that? Thank you.
Thank you, Dr. Samar. Siddham, could you please pass on the mic to the madam here? So we'll come to you right after. Thank you.
Okay, thank you. First of all, on behalf of the Zahid Husain family, I profoundly thank Dr. Khawaja for keeping the spirit of my grandfather alive by talking about democratization of lending. My question is related to some MPhil research that was done at Quaid-e-Azam University about 17 years ago, and which showed that the limits to growth of for SMEs was finance. And you pointed to the same issue. I don't think the profile of SMEs has changed much over the past 16, 17 years. So don't you think that juxtaposing that issue with the leaky pipes problem would also be helpful in moving towards better solutions? Secondly, very quickly, Pakistan's Human Capital Review for 2023 was launched by the World Bank today. It shows a very grim picture for Pakistan. You talk about innovation. Now, how do we bring the level of the human capital stock in Pakistan to a point where innovation really becomes a pull factor for attracting funding? Thank you.
Dr. Khawaja, my name is Zafar Masood. I'm a banker. So, you know, the representation that you were looking for, I'm trying to fill that in through myself. Extremely enlightening, by the way. Thank you very much for enforcing certain ideas that were tentative in our minds. And also, you know, showing us another aspect required to be looked at in terms of promoting financial inclusion. My takeaway from this very enlightening talk from you is essentially the fact that the bankers in Pakistan needs to be trained better on how they need to assess and appreciate the innovation piece. The collateral, non-collateral, the cash flow based lending, and all those aspects are aside. But I think the starting point is the collaboration with people like yourselves to train the bankers who I have no, shame in accepting it, frankly. We become rusty over a period of time, thanks to the affirm of government borrowing, which has led us to, you know, look at always the easier way out of lending. I think the starting point is that the training of the bankers is an essential part. The tragedy which has happened to Pakistan banking in the last decade or so has been the exit of the training nursery, which were the foreign banks, really. So I think that is something which is very enlightening. Thank you very much.
Great. Let me quickly respond. These are phenomenal questions. Each one of them is worth a half an hour response, but
Dr. Khawaja, can we take one more question before
sure,
we just...
sure. I'm
Thank
happy
you.
to take one. Yeah.
Thank you. Sorry. So I'm Riaz I'm also a central banker, part of State Bank. My question is related to, you talked about the behavior traits or the psychometric tests. So I'd like to know the traits which you actually figure out But how do you figure out that which are the traits in a good mind where we can improve the credit scoring? So I think I'd like to have some relationship and how it's done and what are the traits to be looked into when you're looking at it. Thank you.
Great, thank you. Let me, should I respond to the?
Sure, sir. We are here to have your answers now. We'll take any
Great.
questions later.
Great, excellent. These are phenomenal questions. Thank you again. On the both Zafar Saab and the first question on the fugue of the laziness of banking when you have PIB rates lucrative enough, when there's enough spread between your deposit rates and your government borrowing rates, then life is pretty good. So you don't need to do that much innovative work. I think that's spot on. Many countries have had that scenario where banking can afford to become lazy because there isn't pressure. Now, there are two ways to respond to that. One is a macro question, which is why are we borrowing at such high rates when commercially, when deposit rates are so low, right? And you know, it's a deeper question. You know, to the extent that we set PIB rates, you can obviously, there are times when we set them actually too high, it should have been lower. But you may also say, look, we just need to, we're desperate to borrow. And so then the question becomes, why is the Pakistani citizen not willing to lend to its state at a rate which is maybe 3% higher than the rate that its local bank is giving it, right? And so that becomes a deeper political economy question, which is, have we reached a point where we have less faith in our sovereign nation than we do in a commercial bank? And perhaps you guys laugh and say, well, obviously we have reached that point. So there is a situation there, but some of it is policy, some of it is a deeper question to change, which is, can the government borrow at a cheaper rate or not? But there's a second part to that, which is more in our control, which is some of it, and I've alluded to this as well, which is some of it is creating more banking competition, right? You know, you get threatened by two things. One, you get lazy because you can make money just on the spread, but you can get greedy or threatened if you have more people coming into the same business, right? And so my view in a lot of these systems is to say we need to kind of create more entry. And I know Pakistan was trying to do that. Now, there are obviously prudential requirements. You have minimum capitalization requirements of banks and the like. So I'm not trying to change that, but I'm saying we should think carefully about what it means to get more entry and more innovation by allowing it, making it easier for new faces to emerge. And I know we gave digital bank licensing, so maybe that's a step in the right direction, but I'd love to see more of that to address exactly this problem. And in fact, let me jump in and address in the same vein, Zafar Saab, your question, which is very related to this question, which is how do we get more innovation happening in the banking sector? I think you're right. It is a question of training, but I would say more than training, the second thing you said, or perhaps the first thing you said, was collaboration. Look, I don't think necessarily banks should try and internally do all of this. It's very costly. It's not easy to do innovation. It's risky to do innovation. What I do think banks need to do is create the space for innovative collaborations. You know, in a lot of companies, large companies, their biggest tragedy, you know, a colleague of mine who's passed away at HBS, a guy called Craig Christensen, had this idea of creative destruction. Larger firms have a hard time innovating because they're doing well. Why would they destroy their own business? But you can create little innovation hubs in larger firms. And I would argue that's what we should do. You should create little innovation hubs where, and let me say this in a scary way, I can't tell you how many banks I've talked to who want to develop a credit scoring system. They're all excited, please come work with us, develop. And I've pretty much talked to most banks in Pakistan. So in case you're smug and thinking, well, yes, I've actually probably talked to your bank too. And very few of these collaborations happen because I don't think those bankers understand what innovation means. And let me explain. So if I'm to build a credit scoring model, you cannot build a credit scoring model without taking on default. It's impossible, right? You build a credit scoring model by having a portfolio where there is default in the portfolio, so you can come up with a model to predict default. You can't predict default without getting default. So nowadays what I do to most bankers, and this is a sure way for them not to talk to me again, is I say, okay, if you want to develop a credit scoring model, that's great. Tell me what portfolio size are you willing to write off from the beginning? Just write it off, because I don't want to talk to your risk officers every day. Are you willing to write off 5 million rupees? Fine. Let's decide on what it is. And this is a statement to the central bankers as well. You cannot develop credit scoring models unless you create a space where bankers can say, we are simply going to write off $5 million from the get-go. Okay? Write off. Accept it. Then use that money to actually lend in a risky way, which maximizes learning for the model. That's how you build a model. Most of the times I say this to bankers, they don't talk to me again. But that's the honest answer, right? So that's how innovation will happen. You have to be mentally prepared to take. Now, I'm not saying remember what is critical over here is I said, I'm not saying write off everything. I'm saying decide how much amount you can be willing to write off. So it's actually bounded very precisely. And in fact, in a funny way, it's much safer than I guarantee how you guys are trying to innovate currently, because you don't cap your innovation right now. You don't quarantine your innovation. You try and do it when you do it in the bank. And I've talked to bankers, and they say, oh, we introduce a new product and we just try it out and we see what happens. And I'm like, that's not the way you test. That's not scientific. You can do that with a lot of researchers. There's phenomenal young researchers coming up in Pakistan and elsewhere who are willing to work with you. You just have to give them that space to collaborate. And I'm happy to talk more. I represent a research institution in Pakistan called SERP, which the governor mentioned. That's what SERP does. There are other phenomenal institutions in Pakistan which do exactly that. I'm happy to go offline for those who are interested. But like I said, I think the cost of engagement is take it seriously. And that's one example I gave. Zahid Saab, I'm thrilled that you're here, madam. I think your question was lovely. You made my day with that question. Thank you for that. I think a lot of what Pakistan is, a lot of what we are, is a legacy of some phenomenal people we had. So I'm grateful to those individuals who have created opportunities for people like us to exist. The two things you said, spot on. Look, SMEs are the key to growth, absolutely. And let me say something even stronger. I think SME lending in most countries is a joke. It's done to check some box and no one really wants to do it. It's the same thing, Zafar Saab, that you said, if we don't want to make a lot of money, why bother going to SMEs? Let's check the state bank's quota on some lending has to be SMEs and do it. Even on the SMEs, it's more M than S that we do. Again, if you don't like this, please go to your own portfolios, and I've done this on your own banks, and ask yourself genuinely what is your average ticket size? And you'd be shocked in your SME portfolio, which isn't that large to begin it, your average ticket size is pretty large, actually. And then microfinance don't, unfortunately, do SME lending either, because for microfinance, it's too big. They get scared. So there's this missing middle. Microfinance don't lend to the small entrepreneurial firms, and banks don't lend to them because they're too small. So I think there's some genuine work that needs to be done over there. And that, I would argue, should come from a regulatory push in a systematic way. You know, I'm actually pretty optimistic about Pakistan. People say there's a grim picture in Pakistan on human capital. Actually, I do. So half my other work is in education. And when you see what's happening in education in Pakistan is the average Pakistani, especially the average poor Pakistani, is demanding high quality education, is investing more of their annual budget in education than most of you sitting in the audience probably are. A fraction of their budget. The absolute amount is much less than what you're spending, but it's a fraction of what they can afford. They're actually spending probably more. So I actually think there is a lot of human capital in the country. I don't think that's a problem. I think what you said, madam, is exactly right. The issue isn't that we lack talent. The issue is that we're unwilling to lend to talent because we're too afraid to take that risk, which I don't think to begin with is a risk. One small example of that, I started doing a lot of work with low-cost private schools in Pakistan. Over the last 2 decades, I've studied them, and I managed to convince some innovative microfinance organizations to lend to them. And we showed that actually lending to that sector was financially not only viable, but had high returns. So this is a win-win. You're lending to schools which are both a commercially viable entity and are producing the next generation of talent. So why wouldn't you do that? Riasab, on your last question on psychometrics, I'm happy to go offline with you. It's less about what things predict. I can give you 4 or 5 things which predict in the different contexts we've looked at it. For instance, entrepreneurial drive or conscientiousness, optimism, these are things which predict. But that's not the point. It's any credit model is never stable. The point is not, it's not like some Coke recipe, which you make it once and everyone will love it. Even Coke changes its recipe once in a while. Credit models are less about the model itself. It's more about the modeling process. So what you want to do is you want to build a modeling black box in your bank, in your institution, which updates the model every 6 months or every year with more data. You have to constantly be learning. That's the success of firms. Firms which are doing incredibly well in the world are not firms which have built some amazing or have some deep knowledge. They're firms which are constantly experimenting and learning and improving. And so that's the kind of thing you need to set up. Let me stop and if there's time for more questions, but.
Thank you. Ladies and gentlemen, we are running almost out of time, so we'll take last 2 or 3 questions before wrapping up the question and answer session. Could you please pass the mic to?
Yes,
Okay,
this is
thank you.
Esther Perez, IMF resident representative in Pakistan. Thank you very much for the excellent presentation. My question is whether you have engaged or you are planning to engage in a big way with the traditional financial intermediaries, the banks, the MFIs, the VCs, to disseminate your ideas about using the new technologies, big data, psychometrics. What was the purpose of your presentation? No, and possibly suggest ways for them to reconsider or adjust their modus operandi. You have already discussed the experience with Pakistan and MFIs, but I was thinking if there is a plan to do some sort of roadshow, you know, that disseminates these ideas in a big way. Thank you.
I can't hear the lady if you. No, I think your mic isn't great. No, pretty bad. Maybe someone can, maybe you can say the question and the moderator can just
Can we
repeat it.
try the other mic first, please, if you don't mind, madam?
Yes, I think
Thank you.
I'm here, Nandalal Virasinghe, Governor, Central Bank of Sri Lanka. But just to one observation and one question. Observation what you made is quite right in terms of our experience on when the cheap credit is available. I think I can tell you in Sri Lanka 2019, after this Easter Sunday attack, this tourism sector affected. Then central bank and government forced debt moratoriums for tourism sector. What ended up basically is these people had extra money not servicing the debt, and they started buying motor vehicles, luxury cars, say traveling abroad, and all these sorts of things happened, nothing productive. And secondly, during the COVID period also, central bank suppressed interest rates and forced banks to lend at very low rates. And where we also, what your observation is very right, we saw stock market kind of a booming, and people were basically without any opportunities, not investment opportunities during COVID period. People still keep money, took money, and what happened later with tightening monetary policy all ended up in underwater. There are huge stresses in the banking and all this. So that's a good observation. And my question in terms of screening and monitoring, I understand the psychometric test, obviously, I think, and thank you for the innovation. I think that's a quite interesting idea. Is what I see, if you look at the micro lender, informal lender, is kind of a psychometric testing. He asks all the right questions and understand the right attitude of people, and that is what normal traditional bank wouldn't be able to process. I think this is a very scientific and innovation way of doing things. Second part, on the online data, I'm not quite sure what kind of information you would like to process in terms of, say, social media or online. I think I'm not quite sure what kind of process and how you're going to collect necessary information from that method. If you can elaborate, that would be great. Thank you very much.
Thank you. Saddam, could you please take the mic back to the madam who was asking the question earlier? Thank you.
Can you hear me, Dr. Asim, now?
Perfectly.
Yes, Fariha Armagan from STPI. Just two short, quick questions.
Good to see you again, Faria.
Pleasure hearing from you. Do you think that we are caught between the dilemma where we see financial inclusion of economically disadvantaged individuals and also smaller enterprises more as a source of credit risk rather than as an opportunity for investment? And also, do you think that digital financial inclusion, the role and the scope of it, do you think is this the answer to the problem, which evaluates individuals and enterprises on the willingness to pay rather than the capacity to pay? And with such low levels of financial literacy and digital literacy, do you think that it's going to crack the problem? How do we get around it? Thank you.
We are just going to take one last question. Saddam from here, from Zahid Saab's family, please. Thank you.
Thank you, Dr. Asim. A lot of what you said resonates with me. I work in the agri-tech sector, and access to finance is one of the major stumbling blocks for the farmers, especially the smallholder farmers, who constitute about 90% of the farmers there are. The commercial banks will not lend to them. The minimum ticket size, you mentioned that, it's 500,000 rupees. These farmers, they need 100,000 rupees or 150,000 rupees to do their crop financing. And we find it much easier to matchmake them with fintechs who are, as you mentioned, more willing to innovate and take the risk. So just wanted to put it there. Thank you.
Great, thank you. I'm sad I'm not there with you in person. I apologize that I was teaching, so it's hard to make it, but it would have been fun to be there because some of these are really like in-person detailed follow-ups. And I'm happy to, I do come to Pakistan, and I'll let my state bank colleagues know when I'm there. For those of you who are interested, please reach out. Whether I can help you, I'll definitely know people who can. I know lots of really phenomenal academics, so you should think of me as a broker to much better researchers. I'm getting older now, but there's younger, much more phenomenal researchers coming up. And so I'm happy to make introductions to many of you if you're interested. But let me now respond to the questions. Esther, thank you for that question. I don't envy your job right now. Thank you for being where you are, and thank you for helping as much as you can. Sometimes what one needs is tough love, and I'm hoping that is what you're bringing to the table. It's a great idea, Esther. Look, I've done this. In fact, it's interesting you said that. So a lot of the education work that I did, where we managed to convince MFIs to lend to schools, which is actually going decently, happened because we brought a bunch of MFIs together at one conference. And there's nothing like some fun competition to get people to start innovating. And so we kind of posed to them exactly what we were doing and said, here's how we can help. Who is willing to come on board? And it was a bit of like a nudging and cajoling and some friendly pressure and some not so friendly pressure. And I think it was impactful. I have not done that with banks, mostly because it's harder to get a bunch of bank CEOs together in a room relative to microfinance CEOs, it seems. But I'd love to. Any, Esther, not to put the ball back in your court, but any small nudging on your part to encourage things like that. I'm not saying make this part of your conditionalities, but I'm saying I think places like the fund can be really powerful. And I would say the same for the bank, which is a role I really love, is when you become also idea spreaders, not just lenders of last resort, but also nudgers of innovation and idea spreaders. And to the extent that you all can enable that, because you as a fund have unbelievable convening power, both nationally, but also globally. I'm not saying invite me, but I'm happy to come as well. But there's many others like me who are innovators who you know. And for a lot of us academics, especially younger academics, and I'm thinking back when I started my career, we don't know quite how to access. Honestly, we never invited to that big big person room, or we don't even know how to get to that big person room. And so, especially if you're young in your career, to the extent that places like the fund and others can enable younger research talent to have those meetings, to come present, and you can do the screening, right? You can say, who are the interesting people out there? Because a lot of these researchers are known to your researchers. There may be colleagues of your researchers. They may be advisees of your researchers. And you also know the right banks to have in the room. So I think sometimes it is the role of players. And likewise, I would say, Jamil Saab, even to you, the central bank can play a phenomenal role like that, which is get some really interesting, talented people to come in with ideas. And you effectively play the role of matchmakers. The center I direct at Harvard, CID, Center for International Development, very much does that at the Harvard level, at the global level. The center in Pakistan is trying to do that at the Pakistan level. But I think these kind of roles of matchmaking and spreading knowledge are incredibly powerful. And sometimes maybe what brings people to the table is food and money, but perhaps what they should leave with is having consumed interesting ideas. That may be the much more valuable return from that dinner and convening than anything else. But I love your ideas. From the governor in Sri Lanka, thank you for your comment. We had recently had the pleasure of hosting President Wickremesinghe, and so I had a fun conversation with him as well. I am fascinated by what you all are going through. It's a really tough time. Hats off to my Sri Lankan colleagues who are navigating these waters. But I wanted to say two things. One, I wanted to acknowledge that your experience is going to be tremendously powerful for the rest of the world, how you navigate. So please share what you're doing. Please share your successes. Please share your failures, because they will be incredibly valuable for all of us. I wish you all the best of luck in doing that. To your point about don't informal lenders use these psychometrics, absolutely they do. And I think you're spot on in saying, look, what the new world of data is allowing us to do is taking what we already did informally, community banking, informal lending, and codify it. But there's one other thing we're doing, which is powerful. So it's not just we're replicating informal lender behavior by using more access to digital data and technology and credit scoring models. We're actually de-biasing. The problem, and we're making it cheaper. The problem with humans, the good thing about humans is we are amazing in how we screen people. I guarantee most of you screen your friends. And if I ask you which of your friends would you be willing to lend to and which not, I bet most of you will be able to answer that question. And I bet you'll get it almost right? But the challenge with humans, so that's the beauty of humans and bringing kind of this psychometrics and human behavior in. The challenge with humans is we have huge biases as well, right? And we're also costly. What I like about algorithms and machines is in the best of worlds, we can take that insight that humans have, that informal lending has, but we can also check for biases and remove those biases in our algorithms. Biases against poor people, biases against women, biases against a certain caste group, biases against a certain religious group. All of you come from economies where we're suffering from huge biases we face against each other for lots of historical reasons, right? Machines can undo some of that. Machines can also create biases, but we can check for them. And the second thing is machines don't sleep. I can scale machines up really rapidly. So that's the other beauty to me, that if I could take the essence of what the informal lender does, debias it, program it, I can rapidly scale it up, and then I can make smaller loan sizes as well, not just larger. Why is the VC industry effective but such large ticket sizes? Because the skill required is just too costly. If you have to have the partner always be deciding who to lend to, that's just too costly a process. You would ask about online data, what kind? Every kind. Look, I'm a data fiend. You know, how much time you spend playing Candy Crush on your phone and how much time you spend calling your friends and how much time you spend on Facebook may tell me about your behavior and personality in a way that could be predictive. And so what we will have to navigate is the deeper issues of privacy of that data, right? What I'm saying is that data should be owned by the individual. Fariha, to your question, and I'm going to tie that in as well to this, you know, if you want to democratize lending, right, what you have to do is you have to enable the person who generates that data flow to own that data flow and have the right to give it to someone so that it can benefit them. It can help reveal who they are. It can identify who they are, right? Right now, a lot of the data that I'm talking about is not owned by the individual. It's owned by large companies, which are worth more than most economies of the world are right now, right? And so one discussion a regulator can have is to say, we want data to be private and protected, but we also want data to be leveraged to enable, because what a poor person has, as much as a rich person does, is the ability to generate data in a digital world, because digital penetration is massively increasing. My view is actually digital equality will be a powerful tool. I mean, I agree with you, financial literacy is a challenge, but you would be shocked, and I would be shocked at how many people, in fact, engage online, even if they're illiterate. I mean, you all have people who may work as domestic help in your environments who actually will have a cell phone, who will have WhatsApp, who will have some cheap mobile phone. It's not the iPhone, but it's something which is the cheap equivalent of it, right? So I think that world, to me, I'm very optimistic that that world will enable democratization. I'm not naive about it. I think there is a whole digital divide that COVID revealed, but a lot of that divide was not about devices. The divide was about broadband access. I think what we could do as regulators is make broadband access cheap and freely available. And then I think the cost of capital, cost of devices is actually not as large. You can even lend to actually for devices. A lot of cell phone companies do lending to give better phones and stuff as well. Let me end with, again, I think in the right spirit of this lecture, with Zahid Saab's family's question again. Another wonderful question. I'm a huge lover of ag tech, so kudos to what you're doing. I think a lot of, in addition to education, a lot of growth in Pakistan has to happen and will happen from agriculture and from small farmer agriculture. I think technology, there's some really phenomenal things. There's a colleague of mine at HBS who has a startup called Precision Agriculture for Development, actually was working in Pakistan as well, which uses technology and ag tech. The only thing I'd say is, how do you get banks to take on risk? And Priya, you also said this, banks are scared. They see the risk in poor people. They don't see the opportunity in poor people. I think you're spot on. I think we need to lower the cost of them mitigating that risk and make it easier for them to see the opportunity through these screening models. I'm optimistic. I'm not against bankers by any means. I work with all the bankers. And I think if the world will change in Pakistan, the primary money being lent in anyone in the world is through a bank. It's not venture capital. It's not microfinance, it's through a bank. Unless banking changes, we're not going to get these major reforms going. So I do think banking can change. Just two ideas and stop there. One is, I do think even in the ag sector, there's a lot of de-risking we can do by using technology. Climate change is giving us a great opportunity. There's lots of support coming from the world, whether it's through loss and damage and loss and reparations or otherwise, to improve kind of the sustainable situation in any country. I think we should dip into that. We should use that and convince our farmers to go into things like tunnel or drip irrigation, which was the need of the future, the more sustainable need for the future. But I would say tap into those funds, tap into green investment funds to try and get into this sector. And the second thing I would do is think about things which are innovations in the sector, like value chain financing. It's happening in very large number of places. Maybe you as an individual banker aren't willing to take a risk on a bank, but perhaps the downstream buyer of the produce of that small farmer is willing to take a risk on that lender because they're in a tied relationship. That farmer is selling most of their produce to them. And so you can de-risk that loan by saying, look, why don't I underwrite this relationship against the future sale of the crop? And so there's good models of value chain financing and the like that I'm happy to get into in more detail as well. So I think we're badly out of time now. Thank you so much for your time, and it was a pleasure.
With this, we conclude our question and answer session here. I would like to once again thank Professor Dr. Asim Ijaz Khawaja for his patience and candor in answering all of these intriguing and thought-provoking questions from our learned audience. Also, we are deeply grateful to the people here and those who have joined us virtually for for your presence and enthusiastic participation in today's event. Thank you very much, everybody.